Hey, She Slayers, and welcome to another episode of She Slays the Day podcast. I am your host, Dr. Lauryn Brunslick, and I am incredibly excited about today's guest. We have on Garrett Gunderson, who is someone that has been a big name in the healthcare financial world for as long as honestly, as long as I've been in practice, 15 years. He is someone that my mentors turn to for financial advice in building their legacy and wealth. And we cover so many fun topics today, including how your family can build their legacy, lessons that you can learn, and his comedy career. So it's definitely a good episode. If you are brand new to the She Slays the Day podcast and you are just here because you saw Garrett's name and you're like, hey, didn't that guy write a bunch of books I've read? Well, welcome. We're super glad you're here. On this podcast, we cover 3 different main topics for healthcare providers, and that is anything that has to do with causing burnout, boredom, or becoming broke. So today we cover a little bit of all 3, but definitely today is a avoiding going broke kind of conversation. And one of the things I also really like is that so next week's episode is actually going to be Kirby is my husband, our follow-up conversation on some of the things that Garrett talks about in this episode. And, as you'll hear Garrett talk about how when working with a couple, there's always one that is more about freedom and growth, and one is more about safety and security. And as soon as he says it, I instantly was like, oh, I know which one which one I am in that relationship. And you probably immediately know too. And so Kirby and I are going to do a follow-up episode next week, as each of us being the yin and the yang, and how we function as a couple, running multiple businesses together and still maintain being best friends. Sometimes, most of the times. Okay. So today we have Garrett Gunderson, and he is the author of 10 books, including multiple Wall Street Journal bestsellers, with Killing Sacred Cows hitting #1 and making the New York Times bestseller list. What Would the Rockefellers Do, which is one of my favorites, has been consistently among the top 5 titles in Amazon's wealth management category since its publication. He built and sold an Inc. 500 financial firm dedicated to debunking the many widely accepted myths that undermine the prosperity and joy of millions of hardworking, honest business owners. And we get into some of those myths today for sure. Even though his roots are in the world of finance, to test his speaking chops and pursue a lifelong passion, he created a comedy special, The American Ream, which breaks down all the myths about money. Garrett enjoys time at his cabin, especially one-on-one through cash cabin immersions with clients, where he builds their family office, family constitution, and teaches them how to create their richest life. You can follow his blog like it's 2006. That's his roast. That's a self roast. I just want to be clear, especially if you watched last week's episode where I roasted my friend Jake Gernacher. That's a self roast by Garrett. So you can follow his blog like it's 2006 at garrettgunderson.com/musings, or watch videos and interact with him on Instagram at Garrett B. Gunderson. He mentions a couple times, there's a few giveaways that he says in this, that if you message him on Instagram, he'll get you a free link for it. So make sure you listen all the way through for all the free resources. So let's take a breather and relax and get ready for a really in-depth conversation on wealth building. Dear God, thank you so much for the tool that is money. And we know that there's so many things said about money in faith and Christianity and becoming a good person. I really don't believe in all of the negativity around building wealth, and that I believe that good people do good things with money, and good people create good humans who continue to build a legacy and have an impact on the world. There are so many different ways that we can have an impact. So for those of us, just remind us who we are putting on a pedestal, and that, we can have conversations around abundance and wealth, but don't let that become our God. In your name we pray. Amen. Okay, without further ado, here's a conversation I've been very excited for you guys to listen to for a while. Here is Garrett Gunderson. Enjoy. Okay, so actually, this is kind of a good place to start. So, you are known for helping people develop a different kind of wealth, right? Like, was your first book that like launched you into like the public eye, Killing Sacred Cows?
That was the first one. It came out like self-published April of 2007, then it actually got published August of 2008, right in the midst of like the chaos and the craziness and everything.
So
So
you
it was
had
like
written
perfect
it.
timing.
Okay, so it was relevant. It was like perfect timing.
Yeah,
Okay.
because it was like I called my shot and it happened, right? I was just like talking about the dangers of retirement plans and relying too much on the stock market and having no control or cash flow. And like and it just was like and I think that helped the book sales because it hit New York Times. It did really well during that time.
So did you grow up around wealth or did you create it yourself?
So my great grandfather was a coal miner. My grandfathers on both sides were coal miners, and my dad was a coal miner. So we grew up in this literal rural community. Wasn't around money, didn't know much about money. I just had started this little business when I was a teenager, and I won $5,000 and wanted to invest the money. And that is what kind of led me down a path of getting into the money game. Like I just didn't know anyone with substantial wealth.
Okay. And so like you invested it? Like, did you go to like connect the dots here? So like you're a
Well,
teenager, you're given $5,000 or you earn $5,000. You want to do something with it.
Yeah. So I was like, oh, I want to invest it. Well, you have to be 18 to invest. Otherwise you need a custodian. And my mom was like, I don't think you know what you're doing. I'm not going to sign off. So it wasn't until I was in college that I started to interview people. Like I joined this fraternity and I said, who are some of the alumni that work in finance? And so I'd go interview them. And, they were all just pretty much peddling the products that they were, that they were paid on.
But how did you know that? Like there are 50-year-olds who don't know that. Like, because I'm assuming, is that like part of your, I don't want to say like origin story, but like, is that what the moment was that kind of made you go, this is broken as fuck?
No,
Like,
I messed up first. What I did was
okay.
I'm 18 years old and I get invited to this, like, because I was asking everybody, like, who do you know? And people are like, oh, my dad's in finance. You should meet with him. And then someone's like, oh, there's this company that hosts these things on Thursday nights. So I go to it's like an MLM rally, right? It's like basically they've got a really good sales pitch of how you put your money into this investment, and it's tax free and all this. And so I meet with them one-on-one, and they illegally show me an 18% return. You can't show more than 12%. So on a spreadsheet, they're like, it was the 90s. So like, oh, I want to show you what it's likely to do. If you just put $70 a month away, you're going to be a multi-millionaire 40 years from now. And that just sounded, I'm like, well, it's $70. I'm going to do it. But at the same time, I was in college and I was taking an econometrics class. And we had to build these financial models that would like measure the likelihood of things. And so I measured the likelihood of this thing working out. And it had a 97.8% failure rate altogether because I wasn't even funding it at a level that was going to cover these costs that were going to come in because it was an insurance plan. And so I was like, well, that sucks. So 3 months in, I cancel that. I lose my, $210, which I was such like a miser with money that $210 felt like a ton of money. So I was like,
and your parents were just like, we told you not to get fancy.
I don't even know if I told them about it because I knew it would be like, what the hell are you doing? But then I had this like really fortunate moment because I became a senator at the university for the business college, and they just hired a new professor who was retiring as a fund manager and managed $5 billion in municipal bond funds. So this guy's like the best of the best. And I get to meet him before he comes to be a professor. I'm like, cool, I'm taking all of his classes. And in one of the classes, he's like, I want to get in good shape. And so I became his racquetball partner and his workout partner. And I just asked him a ton of questions. And then I actually figured out a strategy that by the time I was a senior, he implemented with me and I got paid on. So I got offered an internship at 19 years old because I'm sitting there figuring out what to do with the money. Mm-hmm. And then, internships basically mean we're going to teach you how to sell. Like I didn't learn the technical analysis of what was going on. I just learned how to be build rapport and sell. And I'd bring my family and friends into this firm. They would sell them stuff. I got paid a commission, and it was good for a couple of years until the market started to go down in the year 2000. And that's when this professor stepped in and really helped me out, because we had already been talking for like a year and a half at that point. And so I got all my clients out of the market. The market went down for another 3 years from that time. So that was like refreshing. And then I just decided, look, I'm young. I'm going to fly somewhere every month and learn from really bright minds. And because I was young, I could get meetings that older people probably wouldn't normally give someone, because it's like, hey, there's this 20-year-old kid asking a lot of questions. And it was kind of like a pay it forward type experience. So that's how I kind of got my feet wet. That's how I kind of got into finance.
Well, and what's interesting, so like I was in like third grade in the early 90s, but I've heard that like the world we live in right now with like social media and how much financial information and advice is being thrown around online, like that hasn't always been legal at all. And honestly, I was talking to somebody at a conference, aren't the ones who actually have the like authority to be giving advice not allowed to say anything on social media?
There are certain firms that won't allow their people to be on social media, and there's certain restrictions if you have certain licenses about having like testimonials or case studies.
Okay.
But for the most part, you can say whatever depending on the company you work for. So, like as an independent, that's why I got rid of my licenses. I used to be licensed at a Series 65, which is a registered investment advisor, Series 6, Series 63, all those kind of things. And I just was like, I had a radio show back in 2004, 2005, and they wanted me to submit what I was going to say beforehand.
Oh,
like I actually knew. So I don't
know what is going to come out of my mouth. I don't know. I can't.
So I dropped the licenses to become more like of an author and more of a speaker. And then I actually built a financial team that I've got the CPAs and I've got the attorneys, and I just, basically build the plan and then they do the implementation. So I'm not actually giving direct investment advice other than when I write a book. I can say almost anything with author's exemption. But if someone one-on-one was like, Garrett, should I be in the stock? I'm like, cool, let me bring in the registered investment advisor and they can talk to you about that. And if they watch my videos, they're going to realize I'm not really a huge fan of the stock market, but that's kind of their personal choice.
Right. I guess my point in that was when you're talking about how you like decided like, okay, this is broken. Everything that everybody's doing is not necessarily like making sense. You took it upon yourself. But my point was like, in the 90s and early 2000s, this wasn't like easy to go and like really investigate someone and be like, oh, okay, they're going against the mold. And so like, how did you find who was, I don't know, would we call it like conspiratorial back then about investing?
What I learned was like, one, I mean, that professor was ranked #1 by every single category in bond investing. So like, I knew for sure he was the guy. He donated money to our university. I flew to the firm that he used to work for in Milwaukee and interviewed there and got to kind of see what was going on there. I just realized it wasn't kind of for me. The other thing that I did was I just started to ask around. Like I would go to events and I'm like, where did you learn? I would go to those events and I'd find the people that were teaching on stage and have conversations with them. And what opened my eyes was there's a guy that basically only worked with uber wealthy families. And I was like a fly on the wall, got to watch one of the meetings. And I'm sitting there watching him just like decimate these plans and then also have them analyze what he's doing. And I got to watch him meet with people that worked on Wall Street, right? People worth like $20 million as Wall Street executives. And they had like 5% of their portfolio in stocks, yet they made their money selling stocks, right? At their firm. And so like that was really eye-opening for me.
Yeah.
And so I just started to like, I even found someone that was advising Robert Kiyosaki. So I interviewed them. Like it's just, you didn't have social media to make the connections, but you could go to events and network and find out who's doing what. And, I just, as an author, I kind of get it. If someone's done something, they like to talk about their stuff. They like when people read their things. So like, I was really researching all the time. Like I went to home offices of major companies to who design the products. And like, those aren't the salespeople. Those are the people who tell you the truth. right? Those are the people that tell you what the downside is, where everybody else is just kind of pitching you on this rosy, great scenario that's always going to work out. But because I had already lived through 2000, 2001, and 2002, which was 3 negative years in a row in the market, I was heavily like skeptical about everything I was being taught by then. Because the first 2 years, it was all the market's always going to do well. And in 99, this guy from New York came in and presented with the firm I was with. And he was like, you guys think it's always going to be this way. It's not. And within 6 months, everything he said came true. So I was like, I want to meet with him. Who did he learn from? And I just, I just kept playing that game. Like, who's your mentor? And again, because I was like 20 years old, people would meet with me.
Right. Yeah. You don't have a flag on your back or, a target on your back yet. Okay. So I promise we won't go down this weird rabbit hole for too long, but like, so when it comes to like traditional retirement, like 401k stuff, that's relatively new in the grand scheme of things. Correct. And like what the story I've been told, I think, is that it was like something like post World War II-ish things, or maybe that was pensions but like
pensions came out, like GE got really big in the pension game in 1947. And the main reason they did was they were trying to recruit big talent to come work for them, but that talent was already working for the competitors. So they offered a pension to attract them to come and work for them. And they did a really good job of those pensions initially, because look, back in those days, people weren't living to 80 and 90 years old. They were, working huge, long hours, smoking every day, like didn't really understand health. And so they were offering these pensions, but those people would die pretty early. And then they would always buy life insurance on them. So they would get this payoff every time someone died to replenish the pension. And then what happened was that Wall Street came and said, you guys are stupid for buying life insurance. It's only going to get you like 6%. You should go with the market, especially in the 90s. They're like, you're going to get 12, 15, 18%, and you can keep the difference. And so everything was going along just fine in the 90s because the market was doing so well. And then the market started to dip in the year 2000, 2001, 2002. And now when people were supposed to be receiving their pension benefits, the money was going down at the same time, and it was a double dip. It started to accelerate that loss. And so we saw a lot of pensions go bankrupt. And so at that point, 401ks were on the rise. They had come out a little bit before that, but it was a way to say, look, as a company, we don't know how to give you a pension because we've had these problems. We're just going to shift the focus to you, and you can put money in a 401k and we'll match it. But if the 401k doesn't perform, it's not our fault. It's on you. And so what we have now is like $170,000 average balance in these retirement plans. And that just isn't going to do that much for people. Less than 1% have $1 million in. And the number one reason they have that is they put a bunch of money in it, not necessarily that it performed as well. And now when someone gets to retirement, these plans are underwhelming. I mean, think about this. Like if someone's a big company like GE, they had access to the best money managers on the planet, and they still fucked them up. They still bankrupted them. So now we're going to put that to an individual, and we're going to think that they're going to be able to provide a good retirement for themselves. Right. And I mean, even worse, they tell them just to put money in it for 30 years until age 59 and a half, whichever is greater. And then they never created cash flow with it their entire life. And now that they retire, they're supposed to create cash flow with something. That's being like not training for a marathon and think you're going to do better because you're rested for, 6 months before you went up. It's like, There's no cash flow training with this. We're not even getting the best managers like the pensions where they didn't make it. And we're shifting the focus to people who know very little about finance. It's a very dangerous system. It's very broken.
So what I'm hearing is 401ks were kind of this like patch to pensions. So like good intention, maybe good intention in the beginning, but now
I don't think so. I think that
okay, that's what I was going to add. Like I always like to go like, I assume people are good. Like they started.
Even the person that created it is anti 401k now. The person that really built the system. The reality is they see how underwhelming it's been. So first off, if you're a financial institution, a 401k is a great tool. Because now most employers, if they set up a 401k, they automatically enroll their employees in it. They have to opt out. So it's like Big Brother. Money's automatically coming out. So imagine if I'm the investment advisor that gets paid by managing the 401k assets, a percentage of what's in there, and now people automatically put money in without thinking. Good for me. Even better, I get to take a fee on the government's money and your money because it's pre-tax. but you still have to pay the tax when you pull the money out. So people think they're in a tax savings mechanism, they're in a tax delaying mechanism. And the biggest problem is if you hate paying tax today, you probably are going to hate paying it 30 years from now. So it's an underperforming asset in that most people will underutilize it because they don't want to have the tax implications. So delaying it doesn't necessarily help. And so, yeah, we have this great situation for institutions, because think about it. If you're a bank, what do you want from people?
I want interest. I want money. Like,
yeah, you want money. How often do you want that money?
Every day.
Yeah. How long do you want to hold on to it for?
For as long as possible.
How much do you want to give me back if I want to withdraw?
As little as possible.
Right. So there's the rules of 401ks. Those are the rules. Hey,
well, but people have to understand that first, though. Like, that, like, it's almost like that's the first, working with chiropractors. Like, it's so interesting to me because most chiropractors can look at the medical system, and like, again, we can say it started good. Most people don't believe that either. Rockefeller, is it?
By the way, I wrote a book called "What Would the Rockefellers Do?"
Yeah, exactly.
Chiro's always hammering that they would destroy our health. I'm like, I'm only talking about their financial structures, not the petroleum became the entire thing that developed big pharma.
I didn't even think about that with you. They were like, how dare you? Like, whatever. You're like, listen, we're just talking about. But yeah, so like a lot of people are like, no, it didn't even start good. But like, so it's so easy for this like kind of like woke healthcare provider to be like, no, like it's broken. I know it's commonplace, but like one of the first things that needs to shatter around how you view money and investing and wealth and all of that is that the bank is a business. Like that your insurance company is a business. And so like when you're asking me questions, I'm like, oh yeah, no, they're not on your side. But a lot of people, they don't even realize that first step. So like with 401ks being so clearly not the thing, how are there so many traditional because I mean every month there's new wealth advisors graduating and going into this, like how is this not more mainstream to think about it differently?
Well, think about this. So have you seen the movie Wall Street with Michael Douglas? Okay, so that movie comes out.
Looks like a blast, by the way. I don't know if I'm allowed to say that, but like
400% increase in broker applications the year that movie came out, because they're like, I want to do the cocaine and have a private plane and have sex with hookers. I mean, that's basically the message. It was a legalized way to steal money. And so what happens is well-intentioned financial people, they actually want to do what's best for their client. It's hard to do what's best because just like a doctor has big pharma in their ear during their entire undergrad because they've infiltrated the system and they become a customer service rep for pills. That's what happens is wealth advisors become customer service reps for Wall Street. And the reality is there's such a high payout. Like if I didn't know any better and I issued 401ks, I'd be worth over $100 million just from issuing 401ks, just from the number of clients I've worked with over the last 25 years, from the way that I could be able to speak. And the reason is I would get paid 1% of every dollar that's in the plan, right? 1%. So if I had $1 billion in there, that's $10 million a year. But if I go to sell that business, I get 10 to 15 times EBITDA as an exit. So it's an insane exit if I sell that book of business. And so what we've got is a situation where, hey, people say things like, I'm a fiduciary. Well, all that really means is that they're getting paid a percentage of your assets. It's supposed to be, I put your interest first, but it's hard to put someone's interest first if the way you get paid is getting a percentage of assets, right? It's just a good story. It doesn't necessarily translate to being the very best thing for the client. Just like, if I'm going to see an allopathic medicine general practitioner, they're basically going to offer me pills, because if they don't offer enough pills, pharma audits them and says, why is it you're not prescribing as much? You're going to get less of a bonus. And we're going to figure out and audit why you're not doing this, because again, we give them authority as a customer, but they're released of their authority inside of a broken system. And that's the same thing happening in finance. Big pharma and big Wall Street is basically the same thing. It's just a different world, health or wealth. And here's the thing, I can't just be like, hey, take care of my health for me. There's no magic pill that gets my health fixed. Like, I have to do the workouts. I can't delegate that, right? I can have a trainer that helps me with it. I can eat nutritiously or not. Like, there's all these things I can do, but the same thing happens in finance. If I think, I'm just going to set it and forget it. I'm going to invest early, often, and always. I'm going to put it in 401k. I'm going to hope it pans out. 95% of the time, it doesn't. And I don't know where else we would trust Wall Street in our lives. Like Wall Street daycare, would you take kids there? You know, they're like, oh, sorry, we lost 7% of your son, but it's just toes, you know? Wall Street Airlines, you fly in that, they'll be like, sometimes the planes go up, but sometimes they come down, right? It's like Wall Street has the worst brand, and yet we trust our money with them because what we've done is not trust ourselves to do the work that it takes to build the wealth that we deserve. Just like we see an epidemic in the United States with chronic illness, that's from an abdication of responsibility, and it's hard to navigate. I get it, people are confused, right? But what I know is if I move every day.
Wasn't it intentionally like designed to be confusing? Like that's why you weren't allowed to like train and talk about it. Like they want you confused. They want you to not understand, because if you like, even if you thought this, like investing in the stocks was exactly what you should do, like do it through someone, like don't do it yourself even. No, that's too confusing.
Right. I mean, that's been the message, right? And I've been around and I've been at part, like my neighbor used to work for Goldman Sachs.
How do you even talk to people? Like, I'm just picturing like you being like, oh, like people wanting to impress you, like, oh, because they don't really know. And they're like, oh, Garrett, nice to meet you. I work at Edward Jones. And like, do you just go like,
oh my God, if someone tells me they work at Edward Jones, I just don't have a conversation with them because I don't know if you know how Edward Jones works, but they prey on the uninformed. They have way more of their offices in rural communities than in metropolitan cities. And they sell the most expensive mutual funds ever created on the planet. And so what happens is it drastically decreases the return for the people that put money in it. And what they do is, again, they go, their policy is, where can we go where people aren't questioning us? Where can we go where we don't have competition? And, you know, we'll just charge high enough fees that if we have smaller amounts under management, we'll be fine. And they get sued all the time.
But if we're going to move on here, I swear, but like, if you, let's say you have a 25-year career, you're going to have people retiring, or 30-year, you're going to have people retiring who have used you and trusted you for the last 15 years, 20 years. Aren't those people questioning like,
right, but they gotta go, well, the market didn't do as well as we expected.
Oh, so they just get
everybody else is in the same boat. Like it's just all that kind of stuff, you know? Like it's just it's lowest common denominator. It's kind of like people go to their same doctor, yet we have 59% chronic illness.
Yep.
Why?
Yep. Must be. Yeah. Okay. So we're not doing traditional retirement, but also you're not a huge fan of like budgeting for cash flow optimization. Right. So again, so you're at a party, you're not talking to Edward Jones guy. You're also probably not talking to Dave Ramsey, I'm assuming.
Yeah, I would love to go on his show. I don't think he would like me. The way I look at Dave Ramsey. Is there
a place for him though? Because in my mind, and I don't mean this.
Okay. Do as he does, not as he says.
Even for like paycheck to paycheck person, like
the train wreck that is spending more than they make, Dave will shake them out of that and start saving more. And so, yes, it will leave them in scarcity and fearing and hating money, but it'll be better than going into debt and bankrupt. So he's very angry about it. He's very mean about it. He's really like, you know, how could you be so stupid? And I'm like, well, look, most people had a medical emergency or a change in careers or, you know, the unexpected things. It wasn't like they were completely reckless and just spending every dollar they had. They just weren't prepared for financial surprises because they were probably doing everything they could to pay off their mortgage. And then think about people from 2005, they get a home, they put every extra dollar they have on paying down their mortgage. And then all of a sudden there's an entire collapse of the real estate market and they lose their house. All that extra money is gone now because they didn't save it. They put it towards a mortgage because, you know, they were just doing all they could to get there. But if they didn't get to the other side, they're in a problem. So yeah, there is a place for him. I think that he's beat up so often because number one, he promotes mutual funds that are loaded mutual funds, meaning with fees, because he makes $70 million a year selling those leads to people that sell loaded mutual funds. If he were congruent with his message, he would put people in an index mutual fund where they're paying almost no fee using Vanguard, because 90% of the time after 20 years, the index beats the managed fund. So there's no reason to pay those extra fees, but he can't get paid as much if that goes. So like, I just know too much, and it frustrates me to know that, you know. And I know that, like, I read one of his books because someone sent it to me as a gag, and it was like these parents writing in saying, all right, we can't get our daughter to spend any money. She's read all your books and now she won't ever spend money. And it's like, yeah, that's kind of the natural conclusion, is to always feel guilt and shame. And I look at expenses as the only way we utilize money, not as a bad thing. It's just,
hold up. I have to like process what you just said. You view expenses as a way to utilize money, not a bad thing. So this is why you are like against budgeting.
well, I want to be clear. There's an alternative to budgeting. So I'm not about recklessly spending all your money. I just invented something called mindful cash management, and I'll talk about what that is. My issue with budgeting is this. It's kind of like dieting. When people get into scarcity and restrict calories to the point that they don't get to enjoy food, they actually increase cortisol levels with that extra stress. And they usually rubber band and start eating more eventually because of that caloric deficit and because they're afraid of food. The same thing happens with money. If we're only thinking about the finite game of what we can eliminate, we might eliminate the very things that make us more productive. Maybe we're not willing to invest as a chiropractor in the right equipment, or in the right associates, or in the right CA, or in the right education, or whatever it might be. And so, yes, they're holding so tight to their money that it's suffocating them from growing. And
yep, I've seen that a ton.
That's my issue with budgeting,
where they're just so like, what is the ROI on this $800 program? And you're just like, oh my God, if you can't figure out how this is going to help you go, this $800 can easily provide a 10, 20, 30x return in a single year. Like, I don't know what to do with you.
Right. So that's the issue, is budgeting is a mindset of scarcity, and it's about what we can eliminate. So I'll frame it this way. There's 3 ways to live within our means. It's just that when I tell most people live within your means, what do you think they hear?
Cut my latte.
Right. And look, that's another ridiculous thing. I remember I got into a vehicle that we were going to dinner with David Bach, who wrote about the latte factor. And my buddy Joe goes, hey, Garrett thinks the latte factor is stupid. And I was like, great way to introduce us. And I just said, I've never met a billionaire that's like, it was cutting out the latte. That's what did it.
It was for me, it was Starbucks. They're just too expensive.
Yeah. So living within your means, if you think just about reducing your expenses, you might cut out productive expenses. Like, I don't have a budget for my ads to sell my books. Mm-hmm. If the ad brings back $1, we put in another $1. If the ad brings back 60 cents, we adjust the ad. And if the ad brings back $1.20, we increase the amount that goes towards it. It's not a budgeting thing. That's a productive expense. But if you're in budgeting, you might eliminate the very things that set you free. And so there's 2 other ways to live within your means. One is to be more efficient within your means. That means plug financial leaks. Most chiropractors tip the government. They overpay on their interest. They have hidden fees or commissions with their investments. They don't design their insurances properly, and therefore it's really inefficient and money's leaking. So those 4 I's, IRS, interest, investments, insurance, are ways you can live within your means by plugging the leaks. But the game changer is to expand your means. That's the real game of wealth. No one shrinks their way to wealth. So if you can expand your means, that's a different way. And so the mindful cash management is you just simply pay yourself first, take an automatic percentage, plug the leaks to help you get there, and then live off the rest. And if you can live off the rest without going out of bounds, you don't have to budget. Like, I don't have a budget. I just make sure that every $1 that comes into my account, a percentage goes to a separate account, and we live off the rest. If there's extra,
hold up. You just made a 60-second thing. Like, here's all you have to do, but you said it real fast and as if we all knew what the fuck you were talking about. Okay, so you don't have to budget. You focus on the 4 I's. And then what?
So when you set up your bank account, you can set up what's known as a sweep account, that every time you make a deposit.
This is profit first, right?
Yeah. Like McAllowitz nails this for sure. So you just automatically set money into the separate account without having to touch it. It's just every deposit, there's a percentage that goes to this other account. There's actually a really cool program called Currents, CURRENCE, that will do this for you, so that you have this reservoir and it shows the different flows of your money, so that you intentionally choose from the beginning how much you're going to save, and then the rest goes so that you can spend what's left over. So that's the difference of budgeting. Budgeting is How much do I have for utilities? Why did that go up? How much do I have for entertainment? How much do I have for gifts? How much do I have for clothes? And, there's just certain times where there might be 3 amazing concerts in 1 month. I don't want to be like, I'm missing those because the budget wasn't right this month. I'm going,
Right.
There's cash in the account. I've already paid myself first. I'm building the right amount of wealth. I'm going to enjoy it. As a matter of fact, the difference is I like to see people have a living wealthy account, that there's an account that money goes into for guilt-free spending. Just money that you want to enjoy, that you don't have to justify to anyone else.
Hold on, I need to make sure my husband hears. He's my editor. Like, yes, okay. Can we get that set up, please, Kirby? Thank you.
Yeah, like when we fly, I want to fly lay down seats. So if that's come from a living wealthy account, I don't feel any guilt.
Right.
This was a silly amount of money I paid for this little cardigan looking thing, and I just love it. And you know what? Other people might think it's a waste of money. I've got friends that will spend so much money on wine, and I'm like, I don't get it. It doesn't taste that much different to me. But again, it's their value, not mine. And so if you have a living wealthy account because you paid yourself first, you've automated your savings, then have some money that you'd be like, what's worth it for you? Go all in on the things that matter, and be like, this is what we want to spend this money for, so we feel wealthy along the way. Because I think wealth isn't just having it, it's how you live it. And if you're always deferring it to the future, you miss out on the wealth along the way.
Right. Okay. So that is a big thing for you, of creating financial independence in like 3 to 7 years instead of the traditional 30-year grind, which I think is sexy when someone hears it. But so first of all, there's a whole delayed gratification there that I think people are like, yeah, sooner, great. So I think there's a delayed gratification issue that I would love to hear, like, and what do you do in the meantime? But first, like, what are some of the key shifts someone needs to make to realistically get there?
So to get there, we have to be more active in our finances initially. And we also have to eliminate a lot of the distractions that we think are opportunities. So financial independence is when you have enough recurring revenue or cash flow from assets to cover your expenses. Most people are thinking, I'll save 10% of my income, chase a 10% return in the market, and wait for 30 years for it to pay off. Mm-hmm. I'm saying, let's plug leaks. That's going to give you more cash flow. Let's determine if it makes sense to pay off a loan or to buy an asset. It depends on the person. If there's someone with a 20% credit card, I'm like, let's pay that off. That's the best investment you can make, is paying that off. But if it's like this house I'm in, which is 2.75%, hey, I can out earn what I'm paying there in my sleep with treasury bills, with cash value. There's tons of opportunity. So I don't necessarily want to pay this off because it creates more leverage for me. And inflation actually helps having a mortgage. Every year, your mortgage feels like less of a payment because of inflation. So inflation hurts our dollar, but it helps our assets.
Right.
Like, our assets grow, but our dollar loses value. So if we borrow or if we have assets, we're in a better position with inflation than if we sit in cash. So basically, I want to see someone pick a lane. Maybe it's business. Maybe they're a chiropractor. They're just going to grow their business. Maybe it's intellectual property, right? This is intellectual property you're creating right now with the podcast. Maybe it's a real estate, but find a cash flow generator or driver that can create that recurring revenue and grow that first before locking money away. And then look to, 3 to 7 years comes from plugging leaks, engineering wealth. So you know what your monthly has to be, basically accelerating investment income. Where can you create cash flow where you're not getting cash flow right now? And then scale your business revenue. There's things you could do with hiring the right people, having the right processes that can allow you to grow the business, and then make it count. Invest back into yourself, your skill sets, your knowledge, the enjoyment of life along the way, so you have the energy.
Okay, so pick a lane. So basically, well, first start with somebody smart, like learn.
Yeah.
Like become awake. Pick somebody smart to help guide you.
Yep.
Then make money is what you said. Like just
make money, number one. Yep.
Make money.
Yeah. Invest in yourself to keep making more money. Then second, keep more of the money you make with the 4 I's. Then third, learn to grow your money by picking an asset class. And I call it your investor DNA. Invest in alignment with your knowledge, your competencies, what drives you, what you find valuable, and then really focus instead of diversify, and then always grow yourself so that you're consistently increasing your knowledge, your relationships, your quality of life.
Mm-hmm. All right. So I'm afraid to ask the next question because I have probably listened to, I mean, not a ton, like 4 hours of maybe collectively in the last 5 years, maybe 6 hours of somebody trying to explain whole life to me.
Okay.
Are you going to be the person that makes this make sense?
Well, I will say that I wrote the book on whole life called
Is that what would the Rockefellers do?
Yep.
Yeah. So I didn't include that in the 6 hours. And I'm not saying your book wasn't incredible. It was. I read it in Cabo, or not in Cabo, in Isla Mujeres, Mexico. It was probably the margaritas. It was probably like it was making sense in the morning. And by like 2 p.m., I was like, what is this guy talking about?
Yeah.
Okay. So for someone who is like listening now, who's like, okay, so not 401ks, not index fund, like not that stuff. And they've heard of whole life. Like,
Okay.
what is it?
So the first thing is whole life is not an investment. So we're not comparing it to real estate or your business or a 401k. I want you to compare it.
So this is, that's not an asset class. So choosing whole life would not be an asset class.
Think of it's your savings. So if you have a savings account, for example, it's earning low interest, it's taxable, it's not protected. If someone comes to get the money, it's just exposed. So whole life would be a different system.
Got it.
Where you have cash value instead of a savings account. You could access your cash value at any time once it's there. There's no tax against it while it's inside of the plan. And once a dividend's paid, a dividend is optional every year, but I would only be with a company that has paid dividends for 100 years and never missed. Once that's paid, it becomes your guaranteed amount. So here's where it's a little confusing. What if you get a 6% dividend and then you run the numbers, you're like, wait, that's said it was 6%, but when I analyze it, it's only like 2% right now. Well, it's because there's a cost of insurance. And in the early years, there's a higher cost of insurance than the later years. Let's say that, 30 years from today, we're talking and you're like, hey, my dividend was 6%. Guess what? My policy was credited 6%. The longer you're in it, the closer your dividend is to what is credited in your cash value, because it's a front-end loaded cost of insurance. Okay.
Right. And I think that's what I think a lot of people don't understand is like, you have to like take care of it for a couple of years, right?
Exactly. You're at a disadvantage for the first few years for sure. But even let's just say you go buy a bond. So a bond is you either gave the government or corporation your money and they're giving you an interest rate in exchange for that. And then it matures at a certain date where you get your money back, right? So you get the interest along the way, money comes back. The problem with a bond is if interest rates go up, your bond value goes down. And the reason is because someone could go buy a new bond and get a higher interest rate than what your bond provides. So they're going to pay less for your bond.
Right.
Right? Because they're like, I'll go get a new one. Screw your old bond, right?
Right.
So that's something called capital depreciation. You lose the value of it. The reason that cash value is a good bond alternative is because once the dividend's paid, it's guaranteed. So it's the lowest it's ever going to be. And if the interest rates fluctuate, your cash remains fixed with the minimum interest rate of somewhere between 2, 3, or 4%. So it's just that the first few years you're at a disadvantage. And what's confusing is there's different companies. Right. There's different policy types.
Because how they're structured is
you can
like
have more cash in some than others, right? You can have what's called a paid up addition where you can put extra in that will fuel the cash faster. So that's where it gets confusing is policy design.
Right.
As just a structure, it's pretty easy. A bank, if you put your money in a bank, it's taxable. They tell you what the interest rate is. Okay. If you put your money at an insurance company, there's different tax advantages that banks can't have. One of the secrets is banks take their money and put it into life insurance for their reserves. They could put a third of their reserves in life insurance. Why would they do that? Because dividends pay higher than savings accounts. And because it's protected from tax versus taxable. So there's, and it comes with this death benefit. So yeah, that's the thing is whole life is just got also like these other policies that aren't whole life that people sell, like it indexed universal life, variable universal life, universal life. I had to write blogs on it because I was tired of talking about it to explain what all that pieces are, because they're kind of like oversold and overhyped, and they look
whole life policies are.
No, the indexed universal lives.
Oh, okay.
they can change your cost of insurance over time where it's fixed in whole life. So it might look better initially, but then later on it becomes worse. And a lot of people look, it's like a seductive, right? It's like a stripper. It looks great up on the front, but then, you know, you're not taking them home for a long-term relationship.
Maybe that's why, like, because it's like, to me, how does everyone, like, why isn't Edward Jones? Like, why isn't this like the obvious thing for people? And do you think that's it, is because it's not sexy on the front end?
It's got cost on the front end. You're at a disadvantage on the front end. It requires a little bit more patience. And so that's definitely part of the issue. You know, it's like, well, I could just put my money in the savings account and it's there. If I put it in insurance, I'm going to be behind for a couple of years. Yeah.
Right. So they have to be structured very specifically, though. And I'm so sorry. I am assuming this is like kindergarten shit for you. And you're like,
no,
oh,
I mean,
but this is important. This is not what, like, the day that this is so common knowledge, we can talk about super advanced, but it's not. We still have tons of chiropractors, tons of healthcare providers who are like, oh, I have my guy. Don't worry.
Yeah. I mean, so we want to look at a few pieces. Like, well, I'm happy to give people my audiobook of What Would Rockfellows Do, by the way, to go deeper on this. So they could
hell yeah, because I had to pay.
They could just DM me on Instagram, Garrett B. Gunderson, and, you know, and then I'll hook them up with it. They could just put your name in there. That would be the best way to do, and then I'll know what to do. So we'll give them that audiobook. But there's certain companies known as mutual companies that actually perform better than stock companies when it comes to life insurance, because they only pay a dividend to the policyholder, or a stock company pays a dividend to the stockholder and the policyholder. So that's one advantage when you're setting this up. Second is you want to make sure there's plenty of cash value early on. And the way you can do that is there's some policies that are just automatically designed to do that. And there's other ways where you can kind of manipulate the policy to do that with something called paid up additions. So that's another piece on it, right? I use my cash value only when it's a really great opportunity, like when I bought my cabin or when I bought a business. Otherwise, I just kind of use that as my savings account. You know, I've dipped into it a little bit, and then I'll put it back in, but you know, I don't have to have good credit. It doesn't require credit to get it. My money still earns interest. It's just they use it as collateral and give me their money, and it's about the same interest rate. So ultimately, I don't have to pay tax by doing that. If I don't pay it back, they just subtract it from the death benefit. But that cash value has beat any bond portfolio over 30 years. It just beats bonds. So imagine this: you buy a bond, you get no death benefit. You buy a whole life, you get a death benefit, and the cash value will outperform bonds over 30 years. But from 10 years and earlier, it's probably not going to beat bonds most of the time because there's a cost of insurance. So you have to get past that capitalization period where you're paying for the death benefit and acquiring the policy. And if you can't, then you can just buy term until you have better cash flow. And you could always convert that term to whole life down the road. And if you're not sure which one to get, you can just buy term insurance until you are sure. It's better to have the right amount of death benefit than it is to have the right policy. Get the death benefit first. And sometimes it might be you're young or you're expanding your practice or whatever it is. Get term insurance. That makes sure if something happens to you, your family's taken care of, and it guarantees your surability. So if you want to convert it to whole life, it doesn't matter what your health is. You get to convert it at the rate when you bought the term insurance.
Got it. Okay. All right. We're getting, I feel like every time I hear about it, I'm like 5 to 10% more. I won't be giving any lectures on it anytime soon. Okay. So you talk about money personas, right?
Yeah.
Like the striver, the high roller. So why is it so important to understand your own individual financial personality before you start making some of these bigger moves?
Well, because we have like a shadow persona and a winning persona.
Ooh.
And if we're in scarcity, our shadow persona will push us into isolation, and we make uninformed bad decisions because of the emotional stress. So a miser, if things aren't going according to plan, will just cut back. They'll just reduce. They'll hide. They'll hold on to what they've got. You know, you just be like, I haven't seen them for months. Yeah, they're just trying to spend nothing. That's kind of like the bad side. Or the conservative will be like, hey, I'm just going to double down and delay more gratification and put more money into my portfolio, even though the market's going down, and I'll just wait longer. Or the striver will be like, I'm just going to work harder. Things aren't going to, I'm just going to do more work. Right?
That was me.
Like,
yeah.
If
Don't tell me I have
12,
to budget. I'll make more
I'll
money.
do 16 now. Right. So it's like they just work and work. And then the high roller, they'll take more risk. Hey, it's not going to plan. They'll put more money in, not knowing whether it's going to work or not. So those are all shadow personas. And they're dangerous because when we come from scarcity, we destroy wealth. No amount of luck or saving, no discipline or rate of return or financial advisor will save someone if they're stuck in scarcity. Scarcity destroys wealth. It leads to isolation. It leads to poor thinking. It leads to emotional baggage. And the higher our emotions in finance, the less likely we are to make sound financial decisions. So the importance is to think more in a co-creation, collaborative effort, thinking like prosperity not being a do-it-yourself game, but doing something like as a team. It's kind of like if you want to go fast, go alone. If you want to go far, bring people with you, that kind of sentiment. And so instead of being the miser who might just look at how they budget themselves, if they're a mindful manager, they might look at how other companies can save money. We had a guy that's a mindful manager that worked for casinos, and he would just go from casino to casino and average a $900,000 savings over 12 months, just finding alternative ways for them to provide services with free software versus paid software, find out where they aren't using things, eliminate it. Like, they were just great. But if they were only looking at their own finances, there's only so much they can save. So it's more about service and solving problems. Or, like a conservative might only think about themselves, where a planner is stable, thoughtful, and strategic. They might build pro formas for organizations and see what margins are, or see what new initiatives would look like, or how soon they need to be profitable, and they help people move along and move forward. Or instead of the striver, you become the creator. Creator's an artist or an inventor, an entrepreneur. They create value with innovation and ingenuity. But instead of trying to do it all on their own, like a badge of honor, they're learning how to delegate. They're learning how to collaborate. And again, the high roller, instead they become a catalyst. A catalyst is a visionary, a connector, a mover and shaker. They think and play big and show us ways we can win together. So if we move to our winning persona and we collaborate, we get more done. If we go to our shadow persona and get isolated, we have limitations on what we can accomplish.
Right. Where can someone learn more about those? Where do you lay that out?
Yeah.
Do you have a quiz?
So Money Unmasked is my book that has that in there. Or they could, again, like if they DM me, we'll give them a money persona quiz, and they can actually take the quiz. They can share it with a spouse or with the employees and get insights on like what's going on in those scenarios.
Mm-hmm. Let's talk just for a minute about like money and relationships, because as you're bringing up different like personalities,
yeah,
I'm assuming in like how much you've worked with people, you've seen two very, very different like mindsets in a relationship. And
that's the universe's way of creating attraction.
So exactly. Yeah. Yes. We're yin and yang. So it's good. It's great. But like, is there like, how do you help them? Like, you almost have to act a little bit like a marriage counselor to get them, I'm assuming, to like start doing something. Otherwise, they're just going to sit and bitch at each other and not do anything for years. They agree to disagree, therefore they're doing nothing. So like, how do you help a couple who may have a completely different view on what the future, the way to get to their desired outcome? Like, how do you help them start to see each other and like get moving?
So it's pretty much every time that one person wants safety, stability, and security, and the other person wants freedom and growth.
Oh, yeah. So, okay. Well, that fits. That fits with this household.
All I have to do is say, like, what does safety, stability, and security look like to you? What would need to happen for you to feel that? And then I tell the other person.
I was going to say, I can't answer that because that's not what, I'm not that person in the relationship.
So if that's met, how would you feel about growth and investing and freedom on this other side? Once they feel like the boxes are checked, they become the biggest cheerleader. But when the boxes aren't checked, they really feel out of control and that everything's at risk. So, for my wife, it was actually a certain amount of money in our cash value of our life insurance, where she's like,
she was the safety one.
Yeah. She's like, if we have that, then I'm good to go. And so we had that. And I was like, hey, I want to do comedy. I mean, if we didn't have that, she'd be like, I don't think you're that funny. I mean, she has said that before.
I'm sorry. Perplexity did not tell me that were you serious there, or was that like
I have a comedy
random?
special on Amazon Prime called The American Ream. It's around
I
like,
am so angry with AI right now that Perplexity did not tell me about the what?
yeah,
Okay.
well, in 2017, uh, we went to like Italy for the summer, which gave me a lot of time to think. And when we came home, I took my wife for my birthday. We went to a baseball game, and it was a little slow, so I'm telling some jokes, and she's kind of laughing, and she says I'm kind of funny. I heard that as comedic God. That's how I translated it.
The
And
moment was
yeah,
June of
yeah.
2017, and my wife said,
August
"You're
the
kind of
11th,
funny."
yeah, 2017. So basically, then
Careful what compliments you give your husband.
I fly to Vegas to speak at this event, and I hadn't spoke for a couple months. I'd been in Europe, and my buddy's like, "Oh, our next speaker's hilarious." I was like, "Oh, damn, I'm giving a financial talk." So I told some jokes, and they went really well. So I call my buddy who was runner-up on Last Comic Standing. I'm like, "Hey, can you be at my office tomorrow at 5?" He's like, "Yeah, why?" I'm like, "I've got some ideas. I look like Jesus. I just don't have his powers. That's my premise. And I want to like write some jokes about it. And I want to do an open mic." So he comes. We spend 2 hours in my office. My youngest son's laughing hysterically as he listens to us. And that Wednesday, I go and do an open mic. And I do well enough that he's like, "Hey, you should open for me." So for 2 years, I'm just like hobbying it around, opening when they're, it's like a Friday night, Saturday night shows. And then they film a comedy special. And it's in an auditorium, where like it's a round where there's just,
Yeah.
I'm the center. And it was like a little nerve wracking, but I just killed it that night. And there was a guy that was a Hollywood manager for a bunch of comedians. Like he managed Chappelle for 8 years, and, Jeff Ross and Louis C.K. and all these guys, and so he's like, "I think you got something here." And I was like, "Yeah, but I'm, this isn't really like my career. It's a hobby." So it took me like a year to talk to him and kind of eventually be like, "All right, yeah, I'll make it more than a hobby." And then I sold my business. And as soon as I decided that, I called him and said, "All right, let's film a comedy special." And we filmed one 5 months later. And yeah, we actually got it on Amazon Prime.
So are you still doing comedy?
I'm speaking and using comedy as a way to communicate, not just going to clubs. I did 2 comedy tours, and it's just not a good lifestyle for me to like
I
be
would
on the road.
imagine. Yeah, I was gonna say, like, you get to a certain point of wealth where you're like, I don't need the money. Like this hobby, if you're not gonna like validate me and make this hobby fun, like I'm not really here for it.
So I just, it's funny because I just spoke at this corporate thing, and they go, "Hey, we know you're a comedian, so we really want you to be yourself, but please don't be offensive." I'm like, "Well, which is it? Do you want me to be myself or not be offensive?"
Yeah.
Because
I don't know
it's
if
kind of like you get one or the other.
comedy, but it tends to be funny because of offense.
I spoke at Florida Chiropractic, that's the big event. And I had an hour and 45 minutes. And when they introduced me, they played my comedy intro. So I was like, well, I should probably do some comedy. And so I did like 50% comedy, 50% content. And the president, David, the next year's president, comes up. He's like, "Dude, we want you back next year, but you deserve more time." I'm like, "What do you mean more time?" He goes, 20 minutes isn't enough. I'm like, "Dude, I did an hour and 45 minutes. But comedy resets time. If people laugh, it's so much easier for them to learn. It's such a more enjoyable experience." So my favorite thing to do is roast people. So I still roast people when I speak at their events sometimes if they want me to. And I just integrate a little comedy when I'm on stage. And then otherwise I do some local comedy gigs here and there, but I'm not like
just
a
like
comedian
small
anymore.
clubs and things like that.
Yeah, here locally I do some clubs which are fun. And I won a comedy rumble, which was me against 8 other people. And then I lost the All-Star Comedy Rumble, but I tested very on the edge jokes just to see what I could do. So I lost, but I was happy. I thought the jokes were good.
So since your wife is she a miser as her shadow personality?
She's conservative as her
Okay.
shadow. Mm-hmm.
Okay. What's the
Which
difference?
means she likes to fact find and have details. And so I used to think I'm the gas, she's the brakes, but now I think of it as she's the guardrails and I'm the accelerator. And so she's like, "Is this what we really want? And what's the ramifications of it?" And all that kind of stuff.
Okay, so you're the freedom person, obviously.
Yeah.
I'm over here. I don't know if you're familiar with Enneagram, but I am absolutely trying to figure, what are you? Do you
I
know?
might be like an 8-7. It's been like
Okay.
15 years
I
since I
was like,
took it,
man,
but
you've got either 7 or 3 in you.
yeah,
That's for sure. But okay, so this is, sorry, am I allowed? How old are you?
I'm 46.
Okay. So like what does retirement look like now for you? Like, are you semi-retired? Do you plan on like kind of working until you're 70? Like what?
I'll work until I die, is basically the plan. But I want to have, like, we took 3 months in Europe one summer. I want to have that, like, take those trips along the way. But after the third month in Europe, I was like, hey, I'm ready to go back to work. And when I sold my business and then I did comedy, like, I was so focused on comedy, just like rehearsing and working on it over 5 months and building the team and all that. Once that was done, then I did a comedy tour, which wasn't as fun because I sold my company, I had no database, and now I'm filling up these venues all across America, which was just a grind. And then when that was done, I was like, all right, I want to get back in the game of finance. Like, it's meaningful for me to write books. I love doing it. It's awesome to, see people get results. So I created this thing called Multiplier, which is I teach every week. I just had a session last night, which was all on all the money mistakes that people could learn and avoid. But then I have one-on-one coaches. So we help people get their financial house in order. And I want to be the most impactful financial teacher for entrepreneurs on the planet. And I want to get 100,000 people in that program before I die. So I have a very big vision, and I don't ever plan on stopping, because I got really bored in 2023, not knowing what I was going to do. Like, I was like, all right, comedy was fun. That's not who I am moving forward. And I don't know what to do next. And I watched all the TV shows that I cared about.
You didn't want to become a crypto bro?
Yeah. I mean, I didn't buy enough Bitcoin early on. So, I was, when I went to buy Bitcoin the first time, it was at $200, and they wanted me to meet him in a McDonald's parking lot to do the exchange. And I was like, am I buying drugs? And I just couldn't do it, And then at $300, I talked to this guy, and he was going to buy it on a Chinese exchange. And I was like, I don't know. So I was a late adopter to the Bitcoin game, earlier than some, but later than others.
Well, some would say it's still so early and that you still have plenty of time. So this is not that's not one of your asset classes.
I put enough into Bitcoin to feel okay about it.
Right. If it takes off, you didn't completely miss the boat. Yeah.
Yeah. I mean, I'm still putting like $1,000 a week into it, but I'm just not, if it takes off, great. It's not going to change what I do in life. Like, that's like that's a way that helps me with potential legacy. And I mean, there's only going to be 21 million, Bitcoin. So I'm like, where else could you buy something that's finite, And I just thought that's kind of a good thing to do. But I like creating value and getting paid for the value. Like, I like when someone reads my book and then we can have a conversation. I like when someone is in Multiplier and I could see the impact I make. Like last night, I asked at the end of the session, I said, tell me why you joined. And man, the feedback we got just feels awesome, right? Like, it's just, so I don't know if that's just, I'm fickle and I like, and I just want
I think that means you're more an Enneagram 3 than an 8, but
yeah, maybe, but I do like kind of that human connection. And I think there's riches in relationships. And I also have, I have more ego than I want to admit. Like, I feel like I missed the boat with social media because I had a radio show that burned me out, and then podcasts came along, and you're
like, fuck no. Yeah.
And now I'm like, you know what? I'm willing to go all in and build a media company, and look at I hired a creative director and a video director and a written director. And I look at my content and how many books I've sold. I look at, how I am on stage, and then I look at my puny little following on social media. And I'm like,
no, you got to do YouTube.
It's challenging. Yeah. I have YouTube that I do. I built a YouTube channel, but I built it in a way that someone taught me, not in the way I want to do it. So I built 85,000 subscribers, and then I abandoned it for a couple of years. And now I'm getting back into it, but I'm doing it the way I want. I'm just teaching once a week. I have an iPad, I draw, the drawing comes up in front of my face, and my producer interviews me off camera a little bit, and I talk topics. So that's how I'm gonna do it.
Okay, so people can find you on YouTube.
Yeah.
And Multiplier. This is
GarrettGunderson.com. They could learn about Multiplier on GarrettGunderson.com.
Okay, you got books. All right. So we want to where can people you message you on Instagram, you said?
Yeah, Garrett B. Gunderson. Yeah, I get into DMs and give them gifts and have conversations. It's like a little pastime for me.
Awesome.
Connect with people.
Awesome. Well, thank you so much. We covered a lot. It was good, all over the place. I think the comedy thing was my favorite surprise in all
I'm glad I
of
could
it.
surprise you at the end there, you know?
Are you speaking anywhere this year? You got any like big plans to speak?
Yeah, I'm starting to do a lot more speaking. Let's see, in chiropractic, I'm speaking at Aaron Gum's event in Dallas in September, I think it is, or October. I've been doing more like virtual stuff, like Life University is going to do a virtual thing with me. Fab Mancini is going to do a virtual thing. I just did an interview with Pat Gentempo last night. Like I'm going to make the rounds back in chiropractic, but mostly from the comfort of my own home. You know, I did years where I was flying everywhere, and chiropractic doesn't want to pay, and I was getting paid by other
No,
so,
the audience has never ever heard me bitch about that.
Well, part of it, you guys are spoiled. You have really good speakers. Like chiropractic has really good speakers from the profession. Dental, not so much. Like I've spoken.
I want to get in on the dental. I want like to get into their little things and see if they pay. So you have any hookups?
They do. I mean, but not as great as I want. Like I'm used to getting $25,000 for a speech, and dental was paying me like $7,500. So it's still, you know. So now I'm like, hey, I'm 25 grand, but virtually I'm $2,500. So I'm just
virtually I can. Or this is like a whole second chapter. So you sell your thing, you go into comedy. Now you're like, okay, I actually miss it, and this is all. Yeah. I love it.
I do have one more comedy thing coming. I wrote a book that's only 20,000 words. It's teaching finance through humor. So the manuscript is done. I have a really amazing editor who had 3 New York Times bestsellers with satire. And so I just need to find an illustrator. And Money Unmasked is still a book I'm kind of putting out there. And I'm also licensing What Would the Rockefellers Do? So probably like 2026 or 27, it'll probably come out. And I think
we'll have you back on the show then.
Yeah, that would be fun. I've shared it with a few people, got really good feedback. It's just 2 chapters are so different than the other chapters because they're like punchline, punchline, punchline. So I just got to figure out the flow of it a little bit. But yeah.
Such a creative process. Awesome. All right, Garrett, thank you so much. She Slayers. Okay, so I'll have as many links below for you as possible. I'll have his like Instagram, so you can click on that and go straight there. I'll have his website, some links to his books and all of that. And you know what? Like, hey, Jacob, my editor, can we find that Prime? Can we find that special? Can we direct link to that?
The American Ream on Amazon Prime. American Ream.
American Ream?
Yeah, REAM. Yeah.
So. Garrett, thank you so much for your time. I really appreciate it.
Thanks for having me. That was fun.
All right, She Slayers, until next week. Bye.